Joining us right now, Seth Carpenter is Morgan Stanley's global chief economist. September 18th is the date. What do you think is going to happen on that date?
I think they're going to cut, unsurprisingly. 25 basis points is our call. I know there's a lot of back and forth in markets now between 25 and 50. The last jobs report was fine. It was well above something weak like 100, but well below something strong like 200. And so they're left with this assessment of what's going on. And that's where I think the spending data, which have been pretty solid, come in, and they are going to see the economy as fine, and inflation's coming down pretty notably, so they need to start cutting, but I don't know that they feel.
And you don't think they look at any of the revisions that took place over the summer and say, you know what, that might even mean that the number we just saw is going to ultimately be revised down as well?
Well, I think they have to look at all of that together. I don't know that the revisions over the summer are going to be what forces your expectations for this revision. It's sort of a funny thing that August often comes in low and gets revised up. And so there's always a bunch of noise in the data. So they're looking at the overall trajectory of things and asking, where is it going?
And then the other big question is, what do you think is going to be on the table in terms of cuts for the rest of the year? Because there is an argument to be made. If you think there's a whole bunch of them coming, do you just rip the Band-Aid in September?
I mean, I think that argument is going to have to be made at the table by several people. Whenever there's an FOMC meeting, the staff prepare these documents with at least three different choices for what to do, and one of them has got to be 50 basis points. And I think part of the argument is both. If things are trending down, why not get a little bit ahead of it? But the other part is inflation is now very clearly trending down. Inflation is now not the threat it had been before.
No, it's an employment issue.
Absolutely.
So the question is, you don't think it's that the employment issue is a big issue?
I think Jay Powell has to corral a whole committee, and I think he's got them moving in the right direction. I think he's got them moving for rate cuts. I don't think he's got them all set to start doing much more dramatic cuts.
So when the rest of your firm calls you, trying to figure out what they're supposed to tell their clients, what are you telling them they're supposed to tell their clients about the equity market right now?
Well, that's the tricky part, right? So we're pretty confident. We feel good. We think the economy is fine. We don't think we're headed for a hard landing. And so in that regard, equity markets should relax. I think the tricky part, and if you talk to my colleague Mike Wilson, right, our equity strategist, he will say the real hard part is where multiples should be. And that's a very different situation from where the economy is going to go in the near term versus where the sentiment is and whether people are rotating into the right sector. And so for us, we feel pretty good on the macro fundamentals. I got to leave it to the equity specialists to think about multiples.
When you think about just play out the rest of the year, though, and the election and everything else, because I want to just understand over the next 12 months where you think rates actually go.
So down from here very much, and we have a whole string of 25 basis point cuts. I think the strategy for the Fed now has to be cut rates substantially, a couple hundred basis points away from where we are so that we're not particularly restrictive. But if the economy holds up, then I think they are going to want to be just slightly shy of their best guess of neutral. So a whole string of rate cuts, trying to put some padding into the economy.
How bad does that mean the employment picture has to get, though?
Well, I think we're already seeing it softening, right? It's come down dramatically. We were getting 300, 400,000. Now we're getting 150 to 200,000. I think it can keep going down from here. And we think the unemployment rate probably drifts up a little bit more, getting closer to 4.5%. But over time, over the next 6-9 months, meaning that it's not a crash, it's just a continued softening.
Seth, we will see whether all this happens the way you expect it to. We hope it does. Hope it's soft. Maybe even better than that. Could it be better than that? Is there any optimistic version of this?
Well, I mean, the U.S. consumer has still held up. Consumer spending has still been strong, and that's 70% of the U.S. economy. And so if the Fed's continues to cut rates, and we see the housing market start to recover, and applications have started to come off the bottom, businesses are going to be looking at a lower cost of capital, especially those who have floating rate debt. I think there is some upside risk, but overall, they're trying to get us into this slower outcome so that it's sustainable in the long run. 3% last year, that's too fast to be sustainable forever.